Hi, this is Stephen from Share Navigator, and today we're going to share with you the covered call strategy. So this is the overview of what we're going to cover. You can pause the video and have a look at that, but this is the flow of what we're going to cover today. We'll move on straight away. Okay, so the covered call strategy, is it bullish, neutral, or bearish? Well, it's really a neutral to slightly bullish strategy. You already own stock, or you're just about to buy stock, you feel it's reaching a high area, and you're then basically going to sell a call option. You're going to receive money in for doing this. It goes straight into your account, and it's really best placed when the shares are reaching your target price. So what is the strategy? How do you construct the trade? Well, the first trade is you own at least 100 shares of stock, or you're going to buy at least 100 shares of stock. And the reason we say 100 shares, in the options market, options are bought and sold in contracts, and one contract controls 100 shares of stock. So in order to place a covered call, you need to own at least 100 and then multiples of 100 shares if you want to do 2 or 3 contracts. The second trade is then you sell a call option out of the money or at the money out for 1 to 2 months. So we'll get into a couple of examples. It'll become clearer then. So here's an example of what we call the buy right strategy. So the first one thing is Hewlett Packard is trading at 33.60. Our target price is 35 for the shares. So we want to generate some additional income. And this is the great thing about this strategy. You can get paid extra for agreeing to sell your shares at your target price. So just imagine the psychology of this. You own shares at $33.60. You're going to sell them at $35 anyway. So you may as well get paid an additional premium for agreeing to do so. So in that situation, we would sell the $35 call out for 1 month to June 2015. So the first trade is to buy 100 shares of Hewlett Packard at $33.60. The total cost of that is $3,360. Then we sell one contract of the June 19 $35 call, and we're going to get 90 cents in per share, or total income of $90. Now, please note that this premium goes straight into your account. That's cash that goes into your account straight away. So what we're going to do now is go and place this trade for real in our demo platform and show you what it looks like. Here we are in the Interactive Brokers demo platform site. So we're going to click on the Webtrader demo and click on Try Demo, and that's going to open up for us now. So we're in here now in the demo system. You can see this is a simulated market data. So literally we're just practicing here. It's great if you can't make any mistakes here, and we would encourage beginners to do that. So you can see we have a watch list here at the moment. We're going to buy 100 shares of Hewlett Packard. So we click on the ask price. The order management window opens up. So we're going to buy 100 shares of Hewlett Packard. And we're going to prepare to pay $33.59. So away we go. We click on preview order. It's asking us, are we sure when to place this? We click on submit. So the order is going in, and you can see we've been filled at $33.59. So if we go now and look at our account positions, this is going to update now in a moment. You can see we own 100 shares of Hewlett Packard. So the second level of this trade is now to sell the $35 call. So remember, our mindset is here that the minute Hewlett Packard gets to $35, we want to sell the shares. Even if they go up further, we would have sold them. So we're going to look to try and generate some additional premium here. And we're going to go about a month out. So today is the 21st of May. We're going to look at the June 19th expiries for call options. And we're going to look at the $35 strike. And we can see if we move across here, we're going to get paid 90 cents per share. So if you look at the bid here, remember when you're selling options or selling anything, it's always the bid price that you're going to get. So we click on the bid, and look what happens here. The order management windows are automatically opened up again. We're going to sell one Hewlett Packard 19th of June 2015 expiry at the $35 strike, and it's a call option, and we're putting in a limit price of 90 cents. So we can't stress enough to people, always put on limit price when you're trading options, because the bid-ask spreads tend to be wider in options than stocks, and you can really lose an awful lot if you don't dictate the price you're prepared to receive. And it's just going to be a day order. So we click on preview order, we click on submit order, and the order's gone into the market there. So you can see there it's being filled. So we're going to look at our positions now again, and you're going to see this updated in a second, and you're going to see -1 call option contract because we've sold it. That's why it's -1, and you notice why it's not -100, because as I said at the beginning, one contract controls 100 shares of stock. So we've sold a $35 call, we've received 90 cents. Our average cost after trading commissions is what we received, which was another 89 cents per share, or $89. So what does this mean here? The bottom line is we own 100 shares of Hewlett Packard. We've got paid an additional after transaction costs $89 for agreeing to sell it at 35. A great way of generating income. So we go back to the presentation now, and we'll show you in greater detail what all of this means. So we've just placed this trade. Some of the numbers here are slightly different. We actually got the shares for 33.59, but you get the message of what we're trying to achieve here. Now, I just want to very briefly explain another variation of this strategy here. This is called the buy right strategy, the buy right covered call. But another variation is the buy rally right. And in that situation, what you could do is just buy the Hewlett Packard shares now, wait for them to rally, and then sell the $35 calls. So let's say, for argument's sake, if the shares rose to $34.50, you could start selling the $35 calls then, and then you would most likely get paid an even higher premium for your calls. So it's really a slightly different approach, but the idea is that you're going to get a little bit of additional premium as the share price approaches your target area. Personally, myself, I usually, if I'm doing a covered call strategy, I will just make my mind up straight away and take the premium on offer at that particular stage, because it's a return-based strategy. And we'll show you that in a few moments as we go through the presentation. So, what is the risk here? Well, this strategy is actually less risky than simply owning shares, and we're going to show that to you throughout the presentation. But there is an opportunity cost to this strategy. Your upside potential is capped to the strike price you pick for the shares. So in Hewlett Packard's case, we picked the $35 strike. That's the calls that we sold. So even if the shares rose to 38, we still have to sell our shares for 35, because somebody else now owns a call option contract and they have the right to take the shares from us at 35. Now, if we change our mind on this strategy, we could buy back those calls, buy our way out of those calls. I wouldn't recommend that. But this is the opportunity cost with the covered call strategy. The other risk is if the share price falls. You're still going to own the shares. You'll keep the premium that you received for the call option, but if the share price falls, there's obviously a loss position there. So what is our max profit? Our max profit is limited. As you can see from the chart here, it's really self-explanatory, really. Your profit potential is capped. And your profit potential is equal to the premium that you've received for the call option plus the profit on the stock. So with Hewlett Packard, if you think we know we got $90 in premiums in for selling the calls, our profit on the stock is $140, because 35 minus 33.60 will be 140, multiplied by 100 is $140. So our total max potential profit in this trade is $230. Calculating your return on investment. Well, return on investment is very simply your profit divided by the amount that you've invested. Now, it's slightly different for covered calls, so you need to pay attention here. Our max profit, as we've already seen, is $230. Our investment is actually less than what we paid for the shares. We know we paid $3,460 for the shares, but we took in income immediately by selling the covered call. So our actual investment was only $3,370. So a return on investment is 230 divided by 3,370, and we get an ROI of 6.8%. What is our break even? The break even for the covered call strategy is the price you've paid for the shares minus the premium you've received, and in this case it's $32.70. So our break even on this trade is $32.70. So that's another great benefit of the covered call strategy. The share price can now fall to $32.70 and we're still going to be in a profit position, and that's because of the extra income we received. So what is the effect of volatility? Well, really, employed volatility is high, you get an additional premium. So the ideal time to be selling covered calls is when employed volatility is high. You're getting paid additional for basically agreeing to sell your shares at a certain price in the future. The effect of time decay is positive for you. This is a real benefit, again, of selling covered calls. You're getting paid to basically lock up your shares for somebody else. And as each day ticks by, the Theta continues to decay, which means that the value of the option is reducing. Now, of course, if the share price jumps rapidly, the real value of the option will increase, of course. But in terms of just time decay, it's positive for this strategy. Okay, so that begs the question, what strike price should you pick and what time frame should you use? And really, you should go out of the money or at the money, because you're still bullish on the stock. Don't forget that. So really, you're talking about maybe going 1 or 2 strikes out of the money, and you're only talking about going 1 to 2 months out. That's really the way you should use this particular strategy here. So here's a great comparison between just buying the stock and doing the covered call. Well, if you look at buying the shares, you're risking 33.60. Doing the covered call, you're actually only risking 32.70. Remember, our break even was 32.70. So our total investment for this strategy was 3,360 if you bought the stock, but only 3,270 if you placed a covered call. Our profit if the shares goes to $35. So if our target price is correct, the shares do reach that. On the long stock, you would have only made 140. But because you took in additional premium on the covered call, you would have made a profit of 230. So a return on investment for the same outcome for just buying the stock is 4.2%, but for selling the covered call, you got an additional 2.6% in. You get dividends if you own the stock. If you have the covered call trade on, you'll still get the dividends. But the one thing you need to be aware of with dividends, if there is a stock going ex-dividend before your expiry date, there's a strong possibility that somebody may take assignment of the shares early, simply because they want to get paid that dividend. So just bear that in mind. But whilst you still own the shares, you're going to get that dividend as well. Now, here's the only downside of the covered call strategy. Your profit is capped. You can't make any more profit than $230. So let's say, for argument's sake, the shares of Hewlett Packard go to $40. You're going to make more profit just owning the long stock. Now, my argument back to you there would be this. You've already set your target price at $35. So if you're true to your word, you would have sold out at 35 anyway. So you might as well get paid an additional premium for doing so. So managing the trade. Well, if the share price goes over your target price, you don't have to do anything. What's going to happen is your shares are going to be sold automatically to the person who owns the call option contract. So there's nothing for you to do here. If the share price stays below the strike price, which is your target price, again, you have to do nothing. The call options will expire worthless. You're still going to keep that premium. And then what you do is you'll sell a covered call for the following month out. So what I'd encourage you to do when you get comfortable with this covered call strategy on stock, please visit our Poor Man's Covered Call. That's where we use a different variation of this strategy. It's cheaper and the return on investment is even higher for this. But please practice with this strategy first. Okay, this is Stephen from Share Navigator. All of our training is free. Please pass this on with your friends through your social networks. And don't forget, if you visit our website, you'll be able to get some of our live trades as well. Okay, thank you. Bye for now.